So what if I told you a company, right in the middle of this huge AI boom, just watched its revenue crash by 40% in one quarter? I mean, your first thought is probably sell, sell, sell. But today we're diving into TSS Incorporated, and let me tell you, that scary headline is just the start of a much, much more interesting story. The real question we're trying to answer here is this: are we looking at simple growing pains, or are these red flags for some really deep problems?
And there it is. That's the number that sent alarm bells ringing for a lot of people. A 40% revenue drop in just 3 months. You know, in the tech world, especially in AI, where it's all about growth, a number like that looks like a total disaster. It's the kind of thing that starts a panic. But is it really as bad as this one number makes it seem?
Yeah, not so fast. Before we jump to any conclusions, we're going to do what you should always do. We're going to pop the hood and take a look inside. We're going to use the company's own earnings report and what they said on their conference call to piece together the real picture. Because behind that jarring number, there's this fascinating story about strategy, about long-term vision, and frankly, about the massive challenge of actually building the stuff the AI revolution runs on.
Okay, so to really get a handle on their financials, we first have to understand who TSS even is. What do they do? This isn't just some name on a stock ticker. They are a super important piece of a very, very hot industry. So let's meet the company behind all these numbers.
So who is TSS? Well, you can think of them as the master mechanics for the AI world. They don't make the fancy AI chips, but they do the really hard work of putting everything together. A huge chunk of their business is integrating what are called AI rack systems. So they take all the pieces, the servers, the super powerful GPUs, the special networking gear, even the liquid cooling systems, and they build these into massive, powerful server racks that the big tech companies, the OEMs, need to run their AI. On top of that, they have this other business where they supply tech equipment to big clients, like the US Department of Defense, and they also manage the data centers themselves. So bottom line, they're the expert, hands-on builders for the AI age.
All right, now that we know what they do, let's get back to those financials. Let's dig into this quarter of contradictions. This is where we're going to unpack that crazy headline number and see what is really going on.
Here it is again, the number that started all this. A 40% drop in revenue in the third quarter, down to about 42 million from over 70 million just last year. I mean, you look at that in isolation and it looks like the business is in an absolute freefall. But that's only half the story.
Because if you just zoom out a little bit away from that 3-month window and you look at the whole year so far, the picture completely flips on its head. Year to date, TSS's revenue is actually up a staggering 88%. We're talking nearly $185 million this year compared to just $98 million last year. So the big question is, how? How can both of these numbers be true at the same time? And this right here really shows you the danger of looking at just one data point. That quarterly view with the 40% drop, it just screams problem. It tells a story of failure. But the yearly view showing an 88% surge tells a story of incredible momentum. So this contradiction, it isn't a mistake. It's actually a clue that something very specific and probably temporary happened in that one quarter, something that doesn't really reflect the overall health of the business.
And boom, here's the explanation, straight from the CEO himself, Daryl Dewan. He makes it crystal clear that big drop was almost entirely because of lower revenue from their procurement services. Remember, that's the part of their business with those big, lumpy government contracts. One quarter you land a huge deal, the next quarter, not so much. The timing is just all over the place. But here's the absolutely critical part. He also said that their main business, their core AI systems integration, actually grew by 20% in that same quarter. So the scary headline number wasn't a problem with their main engine. It was just a timing quirk in a different part of the company.
Okay, so the revenue story makes a lot more sense now. It's way more positive than it looked at first. But a business with these kinds of ups and downs needs a really strong foundation. So what about the company's actual financial health? Is it stable? Can it handle these lumpy quarters? Let's run a quick health check on its vitals.
First up, we've got something called the current ratio. It sounds technical, but it's a really simple and powerful test. It just takes all the company's short-term assets, cash, inventory, money that's owed to them, and it compares that to all the bills they have to pay in the next year. It's basically asking, hey, if all your bills came due tomorrow, could you pay them? Think of it like a financial safety cushion.
And TSS's current ratio is 1.52. So what does that mean? Well, a ratio of 1 means you have exactly enough money to pay your bills. Anything below 1 is a big red flag. At 1.52, TS has more than $1.50 ready to go for every dollar of bills they have coming up. That is a really solid cushion. It tells us they can easily meet their short-term obligations. First vital sign, looking very healthy. Okay, next up, let's look at their long-term stability with the debt-to-equity ratio. This one gives us a sense of how much the company relies on borrowed money. It compares total debt to the total value that belongs to the owners, its equity. The easiest way to think about it is like buying a house. If you take out a huge mortgage, you have a high ratio. If you pay mostly in cash, you have a low one. And for a company, lower is almost always better. It means less risk.
And TSS's debt-to-equity ratio, it's just 0.38. That is a very strong number. It means for every dollar of value the company has, it only owes 38 cents. This is a huge sign that they aren't drowning in debt. They're funding their growth with their own money, not by borrowing a ton. For a company that's investing so aggressively in the future, this financial stability is just crucial.
All right, so let's recap for a second. That scary revenue drop? Turns out it was just a timing issue. Their financial health? It's solid. Low debt, good safety cushion. So now we get to the most exciting part of this whole story, their plan for the future. This is all about playing the long game and getting ready for the absolute tidal wave of AI growth they see on the horizon.
This quote from the CEO, Daryl Dewan, just perfectly sums up their entire mindset. He says we're in the first quarter of the AI game. Now that's not just a clever soundbite, it's a strategic mission statement. It means they are not managing this company for next quarter's results. They believe the real, massive growth in AI is just getting started, and they're making big, expensive moves now because they're building the stadium for a game that's going to be played for decades.
And this isn't just talk, by the way. They are putting serious money where their mouth is. First, they built a brand new top-of-the-line facility. Second, and listen to this because this is a huge deal, they upgraded their electrical power to 15 megawatts. That is an insane amount of power, enough for thousands of homes, all dedicated to handling the next generation of power-hungry AI chips. Third, they're pouring money into the backbone of the company. New systems, better processes, and hiring more smart people. And all of this is for one reason, to be ready for step 4, which is to be the go-to partner for the biggest names in AI when their needs just explode. And this is what that vision costs. $32.2 million. That's how much they've spent on these long-term investments, the building, the equipment, just in the first 9 months of this year. This spending is exactly why their short-term profits are a little squeezed right now. They are intentionally taking a hit on profit today to build a much bigger, much more capable company that can win a much bigger prize tomorrow. This number is the proof.
So, we've looked under the hood. We've untangled those contradictory numbers. We've checked the financial vitals, and we've dug into their long-term strategy. Now it's time to bring it all together. What's the final prognosis for TSS? What's the bottom line here?
Let's look at a balanced scorecard. On one hand, the good stuff. They are in the perfect spot to ride this massive AI wave. They've got that incredible 88% year-to-date growth and a rock-solid financial position with low debt. And they're forecasting huge profit growth for the full year. But you have to look at the other side of the coin, right? There are real risks. As we saw, their quarterly numbers can be super volatile. And all those big investments mean they have high fixed costs now. Plus, there's a huge operational risk. Can they actually scale up fast enough to meet all the demand they're preparing for? And of course, their short-term profits are taking a hit because of all this spending. Which brings us right back to the final critical question. And the answer really depends on how you look at it. Is this a company making a huge, risky bet on a future that might not pan out? Or is this a smart, financially stable company that is methodically building the essential, non-negotiable plumbing that the entire AI revolution is going to depend on? The story of TSS is just a powerful reminder that sometimes the most alarming headlines are actually signs of a company in the middle of a very bold and maybe, just maybe, a brilliant transformation.